Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Tuesday, everybody, and a big shout out to Joseph, a subscriber from the US who I had a one-on-one conversation today. It was great to talk to you today, and I very much appreciate the conversation. One-on-one conversations are available at the link in the description below. We start today's episode by covering a quick update on the housing sector before we move on to the main development. According to new data from China Real Estate Information Corp, the slide in China's home sales, unsurprisingly, accelerated in December. The value of new home sales among the 100 biggest real estate companies fell 34.6% from a year earlier to just under $500 billion, approximately $60 billion, accelerating from a 29.6% decline seen in November. December's sales were up 15.7% month-on-month, however. That puts major developers' full-year sales in 2023 down 16.5% versus 2022. Thus, home sales declined 20 out of the past 24 months. Once again, this performance demonstrates that despite all the government support pumped into the sector, housing remains in a difficult place and will continue to worry policymakers as we move into this year. In the latest move to revive demand, authorities relaxed home buying curbs in Beijing and Shanghai, two of the country's biggest housing markets. These changes followed central government guidance to cut down payment requirements in late August. We will continue following property as it unfolds into yet another year. Okay, now for the main content of today's video. The last few days have seen dozens of opinion pieces and reports on what 2024 will mean for China's economy specifically and the PRC generally. Today we will examine selected excerpts from what I believe are three of the either best or most thought-provoking explorations of this question. The first is called China's Many Systemic Problems Dominate Its Outlook for 2024. It was penned by George Magnus, a research associate at Oxford University's China Center and a veteran China economist. We quote some of his observations from the piece, which was published today directly. The Chinese Communist Party's prickly attitude to criticism is not uncommon. It chooses instead to propagate a narrative of continuous success in which its own role is pivotal. The reality, though, is that systemic problems have over the years become features in China's $19 trillion economy. It may seem churlish to draw attention to these things in the world's second-largest economy, center of global exports, manufacturing and supply chains, and home to brands such as Alibaba, Tencent and TikTok. Yet Japan, 30 years ago, reminds us that it is quite possible to have islands of technological excellence and leadership, and also deep economic imbalances, deflating asset bubbles, over-indebtedness, and institutional weaknesses that compromise growth and prosperity. Technological prowess could not prevent Japan from succumbing to its proverbial lost decades, and there is no reason to think differently about China. China's 2024 outlook is likely to be more challenging than last year's. The party will probably adopt a 5% GDP growth target again, but it may prove more elusive than 2023's, which had COVID weakness in 2022 as a comparison. Those expecting meaningful macroeconomic stimulus and reforms will continue to be disappointed. There will be some tax cuts and fee reductions for businesses and more support for the beleaguered housing market, but only to stabilize the economy. Monetary and credit policies will remain prudent. There is no suggestion that the government will adopt serious measures to boost consumer demand and household incomes. Faced with an array of domestic economic problems, China should ideally substitute market and structural reforms for the more familiar strategy of doubling down on already high manufacturing, investment and exports. But it won't. As a result, the economy will become still more unbalanced. This policy focus will trigger a new round of trade war as China's industrialization and export push forces the US and Europe to import more Chinese products and de-industrialize. The US, EU and other industrial countries will not go meekly to another de-industrialization graveyard in this way. The next piece is called 5 Big Uncertainties Facing the Chinese Economy in 2024 by Tianlei Huang and Mary E. Lovely of the Peterson Institute for International Economics. In the piece, the authors argue that the Chinese economy's rebound started slowly last spring, shaking off the effects of an estimated 1.41 million excess deaths from the pandemic and China's zero-COVID policies. Today, although growth will likely meet the government's 5% growth target for 2023, the Chinese economy remains troubled, plagued by flat private investment, flagging consumer confidence, and high youth unemployment. Falling prices and depressed business and consumer confidence are flashing warning signs about the year ahead. The authors then unpack 5 big uncertainties about Chinese economic performance and the government's policy responses that will determine whether growth can be sustained in 2024. We once again quote selected excerpts of this piece directly. 1. Can China avoid a deflationary spiral? China's deflation pressures have worsened in recent months. If prices continue to fall, consumers and businesses will likely put off buying and investing in anticipation of further price declines. A deflationary spiral would lead to lower production, falling wages, and rising unemployment. Even now, rising deflationary pressures are pushing up real borrowing costs, adding to the country's already high debt burden. 2. Will the government tackle the debt deflation spiral with greater stimulus? The textbook response to weak aggregate demand and falling prices is stimulus, but the Chinese government acted tentatively in 2023. Shang Jinwei of Columbia University suggests that China needs to adopt the whatever-it-takes approach pursued by the European Central Bank a decade ago to halt the debt deflation spiral into which China is falling. Recent signals coming out of Beijing's Central Economic Work Conference, however, suggest this approach won't be taken. If monetary stimulus is weak, fiscal policy may play a more prominent role in 2024. The Chinese government has long been reluctant to run a headline fiscal deficit larger than 3% of GDP. But Beijing's recent budget adjustment, namely the issuance of an additional 1 trillion yuan in sovereign bonds, the entire proceeds of which will be transferred to local governments, seems to suggest that the authority is rethinking its long-term fiscal conservatism. 3. Can private sector confidence be restored? Low confidence in a sustained recovery was expressed repeatedly by economists, business leaders, and working people during our recent trip to Beijing. Chinese consumer confidence remains at a historic low despite the short-lived improvement in early 2023. 4. Can the government stem the property downturn? With sluggish sales, real estate developers continue to struggle with their liquidity crisis. Perhaps in response, the government's real estate policy recently shifted from supporting demand toward supporting developer financing. 5. Will foreign direct investment into China rebound? It's not only domestic investors who suffer from low confidence in China's economy. China's balance of payments data show that foreign direct investment, FDI, is exiting China at a record pace. Foreign firms are not only refusing to make new investments, some are also selling existing assets and remitting earnings back to headquarters at scale. The Chinese government has taken note, and it has offered more supportive rhetoric and policies to reignite inflows of foreign investment. These efforts confront foreign businesses' promise fatigue, as they remain skeptical that the authorities' supportive rhetoric will actually translate into meaningful policy actions. Other factors that have contributed to the recent collapse in FDI, including worsening geopolitics, are unlikely to reverse course soon. Given these factors, it remains uncertain whether foreign investors will return to China in 2024. Okay, next up we have one more piece to cover. I hope you're enjoying today's episode. If you're getting some value from this episode, I only have one ask. That is to like and subscribe. This is the primary way in which this channel grows. The main way it is shown to new people is if the algorithm is happy. For anyone who wants to help keep the channel financially sustainable, which allows me to continue doing this every day, open and free for all, Patreon and Buy Me a Coffee links are in the description below. My commitment has been a channel open to all that is reliant primarily on subscriber support rather than corporate sponsorship. And with your assistance, I know I can keep it that way. Thank you so much, everybody, for the ongoing support. Finally, for today, we examine a thought-provoking piece from several veteran authors with US-based Rhodium Group, including Logan Wright, who we have quoted extensively in previous episodes, called Through the Looking Glass, China's 2023 GDP and the Year Ahead. The piece reviews 2023, then looks ahead to what to expect in 2024. This year, the piece argues, China will see a modest cyclical recovery in some areas amidst an ongoing structural slowdown. The Bloomberg consensus estimate is for 4.5% growth in 2024, down from 5.2% in 2023. The Rhodium team believes growth will be stronger next year relative to 2023, based primarily on a cyclical recovery in the property sector. However, and this is what is most critical to note, quote, the structural issues left unaddressed in 2023 will continue to drag down China's potential growth, end quote. Once again, we quote selected excerpts from the multi-authored piece directly. 2024 investment, Rhodium estimate, 1 percentage point. As in 2022 and 2023, the investment story to watch in 2024 is property. Last year's downward surprise to consensus forecasts was due to the deepening property contraction. Next year's surprise will likely be the sector bottoming out and even making a small contribution to growth. A broad investment recovery is unlikely. Beijing is dealing with local government financial stress by forcing banks to absorb non-performing local government financing vehicle debt. Banks' profitability and their ability to lend to productive firms will suffer. 2024 government spending, Rhodium estimate, 0.5 percentage points. Given ongoing economic strains and policy disappointments in 2023, observers watched the December 11th to 12th Central Economic Work Conference for signs of more expansive fiscal stimulus. The conference statement mostly disappointed on that front. Land sales revenues are paid with a lag, so weak 2023 land sales will weigh upon 2024 local government revenues. Ultimately, Beijing must scale back its fiscal ambitions and redirect spending to boost the productivity of human and physical capital. 2024 consumer spending, Rhodium estimate, 1.5 to 2 percentage points. With income growth still slowing and continuing deleveraging ahead, 2024 household consumption should look much like it did in 2023. Household indebtedness remains high and households are continuing to deleverage, reducing consumption. Household debt as a share of GDP is currently at 63.8%, which is around the levels the US saw shortly before the 2008 financial crisis. 2024 net exports, Rhodium estimate, negative 0.25 to positive 0.25 percentage points. In goods trade, there are numerous headwinds for China's exports next year. Both the IMF and OECD forecast a modest global economic slowdown in 2024 to a level well below historic average. Trade policy activism is rising in Europe. The combination of still high US interest rates, low Chinese interest rates, and the fundamental desire for Chinese households to diversify their home-based wealth overseas will continue to put pressure on the RMB to depreciate. 2024. Putting it all together. Putting these components together, our best guess for Chinese GDP growth in 2024 is 3 to 3.5%. Our view is out of consensus in three regards. First, we believe that China will grow more slowly next year than other mainstream forecasts imply. Secondly, while most forecasts expect growth to slow further next year, our 2024 baseline forecast of 3 to 3.5% growth represents a cyclical improvement relative to our 2023 baseline of 1.5%. Put simply, we think the economy next year will look better than last year. But nothing like the pre-COVID growth rates that an improvement on China's official figures would imply. Third, while most forecasts expect the property sector to continue declining and government spending to step up, we foresee the reverse. Fiscal policy will disappoint this year, and a cyclical recovery in the property sector will provide a small boost to growth, or at least no longer act as a drag. How could our forecast be wrong? It is possible that the property sector continues to decline in 2024. While we have seen early signs of stabilization and are now around activity levels consistent with long-term fundamental demand, there is a real possibility that the correction in the property sector overshoots because of the financial distress among private developers, representing a downside risk to our 3 to 3.5% growth forecast. Household consumption risks also lean to the downside. The upside to housing spending is fundamentally constrained by slowing disposable income growth and a continued property market decline, or any number of economic shocks could depress consumer sentiment. The piece concludes. For now, however, the official messaging on China's economy remains controlled and ideologically rigid. Among the primary tasks listed in the official readout of the Central Economic Work Conference was to strengthen economic propaganda and public opinion guidance and to promote a positive narrative about the bright prospects for the Chinese economy. For businesses and policymakers alike, this makes having a critical and objective view on China's economy all the more important in 2024. Here ends the direct quote and today's episode of China Update. I certainly agree with that final point about how critical it is to have an objective view on China's economy this year. And I hope we can continue to do that here on China Update. Thank you so much everybody for watching. Have a wonderful Tuesday, have a great week, and I will see you all tomorrow.